Hello and welcome to the Exit Planning for Dentists webinar presented by BlueWater Dental Advisors. I am Stephen Huskey, certified exit planner, co-founder, and a dental advisor with the BlueWater team. I have my esteemed colleague and co-founder, as well as dental advisor Brandon Wilson, with us today. This information is marketed specifically for dental practice owners, but this can be taken into account for any business owner as long as you're privately held. So if you're going to get a lot of great information out of it, I'd assume that we'll send you the recap of this. We'll send you the recording for it, share it with your team. I hope you get a lot out of it today. BlueWater Dental Advisors is centered out in Charleston, South Carolina. We have the Tri-County area that we work with a lot of dentists in currently, and we are taking this nationally. So we've got folks all over the country that we've been assisting over the past few years. And we also have our Chief Marketing Officer, Shelby, to thank for all the beautiful artwork that you're going to see today. So definitely glad that she is part of our team and helping us look good for you guys. So I want to share real quick a couple things about BlueWater before we get into everything. So we're going to share our core values today, what we do for dentist practice owners, the reason we got into this field, and the value that we can add for any dentist business owner, whether you're an aspiring business owner or you're a current one today. Core values of our team. Number one, we want to keep things super high level. Simplicity is key in everything that we deliver. So you'll find that this presentation and information for any practice owners is going to be very simple and easy to follow. And we follow all of that up with an educational approach. We want to make sure that everybody can understand what we're discussing. It's in layman's terms because we're in the finance world and we study this stuff every day. I don't know all the acronyms that the dentists use, so I'm still learning all of those things. So education is a really big factor into what we want to provide for anybody who's interested in the dental world. Inspiration is our third core value, and we're very interested in inspiring people to make moves, to start planning, to start looking towards their future, to put goals down on paper, and to really make sure that we are inspiring folks to light a fire and do something with it. And then lastly is we always want to put family first. If you could see our calendars right now, you would see that everything that we have on there, our rocks on our calendars, are the ones that put our family first. And we encourage all of our dental practice owners that work with us to put their families first as well. So, go out and spend some time with your kids and your grandparents and your loved ones, and make sure you're telling them that you're, happy to be with them and love them. So, how you can get in touch with BlueWater Dental Advisors. You can go to info@bluewaterdentaladvisors.com. Shoot us any questions that you may have around the subjects you're going to hear about today. Go to our website, bluewaterdentaladvisors.com. You can find a lot of great content on there. We spent the better part of the last year and a half putting some really diligent content out there for all of our practice owners. One of them being a 1-hour CE credit video around the subject we're going to discuss today, the 3 different doors of exit that you can choose, the pros and cons of each, and how to maximize your practice at sale. And then we also have a 9-video series, about 3 to 4 minutes each, because we know your time is valuable, on different concepts that we educate some of our folks on. So you'll really get a lot out of that material. We're also very, very heavily involved on LinkedIn. So please go find BlueWater Dental Advisors on LinkedIn and follow us. We have great content coming out all the time, and we hope that you engage with it. Our number is down there as well, should you want to call. We have a chat box in the studio, everybody. So if you have any questions and you want us to answer them, please put them in the chat. Happy to get in touch with you that way. All right, so really basic information around why we found it important to talk to folks like you today about exit planning. And the number one reason that we found was important to start talking about it today is due to a study of dentists throughout the country by the National Income and Retirement Institute. The American Dental Association as well has found that the average retirement age for dentists is age 69. Sounds a little bit off from the average retirement age in America, which by a survey done of the general population, that average retirement age for Americans is age 62. So there's got to be some reasons why folks are pushing their retirement age out 7 more years than the average American. So we're going to discuss that a little bit today as well. Some really neat facts in there. Another reason why people might wait longer to retire or to invest more into their practice or into exiting is that the average dental school graduate owes just shy of $300,000 in total student loan debt. Myriad schools you might go to, different forms of student loan debt you might take on, but it takes a lot to get through dental school, and we recognize that. The average student loan debt of other Americans outside of the dental industry is $37,000. So that is one contributing factor that we found as to why folks are pushing off their exit out of their dental practice sooner than later. And the biggest key takeaway here is that the problem with most dentist exit strategies is that they simply do not exist. You may have an idea of what you'd like to do, but don't know the steps that it takes around the complexities of your exit. And you only get one shot at the largest financial transaction of your lifetime, which is the sale of a business. And so we're going to go through the 3 doors of exit today, the different options or choices that you can make, the different partners that you might want to bring on to help you accomplish this insurmountable, what may feel like insurmountable feat, and how you can actually overcome those with simplicity in education. So with that being said, thank you again for attending today. We appreciate your time. We will make it educational and high level. And I want to introduce my cohort here, Brandon Wilson.
Thank you, Steve-O. Appreciate you, buddy. Shelby, can you hear me? We good? Everything's good. Thank you all for tuning in today. Just to piggyback on what Steven's already hit on is, we don't want this to be boring, number one. Financial guys are boring. We just are. We're talking about stuff that nobody wants to talk about. But it's very important, may not necessarily be urgent. And as a business owner, whether you own a widget factory or a dental practice, there are some inevitable things that will happen throughout your business cycle. And we try to help our clients and folks that we just give education to in general understand that you're going to leave your business one day, whether it's voluntarily or involuntarily, toes up or toes down, as we say. And the decisions you make today from a planning standpoint are either going to have a negative or a positive ripple effect on that outcome, which is getting out of your business. We call it exit. That sounds kind of gloomy. Maybe we need to figure out a different word for that, Stephen. But in essence, we're talking about the sale of your business. And if we look at the balance sheet of the average business owner, I'd say 95% of the time, that business is your single greatest asset. It's like thinking about an ATM machine. If I had an ATM machine in my yard and it just spit out money every day that I went out to check it or take care of it, I would take care of that ATM machine. I would protect it for all it's worth. And that's in essence what a well-run business can be. I'm going to share my screen and walk through a few slides. I want to throw out the caveat that, number one, what we're giving you right now is not advice. We're not going to get into the nitty-gritty on details on how we solve some of the problems that we're going to hit on. We just want to address the concerns and make sure that we bring awareness to the fact that you got to start planning for this inevitable exit today. Share my screen. Steve-O, this is my first webinar, man. You got to help me with making sure that my screen pops up like it's supposed to.
I'll help you out, my friend. I got you.
Thank you. I'm an old school guy, by the way. Here we go. This goes back to what I just said. Everybody see, Steve-O, you see, Shelby, we see 100% certainty that you'll leave your business.
Yes, sir.
Like, percolate on that for just a second. Seems pretty easy stuff, right? Pretty fundamental. The problem is we're so busy doing what we do best during the day that we just don't put a lot of thought to this most oftentimes. And when we do, it's usually because of something bad that happened, whether it be health related or we had a friend or a colleague that left their business involuntarily, and it made us think about this. If you're a medical professional, and I can say this in generalities, not just dentists, you guys and gals went to school a lot of years. Like, you're super smart people to be able to pass the test that you pass, to get the licenses you have and do the important work that you do. You probably didn't get a lot of schooling on running a business. So a lot of things are done sort of trial by fire. But at the end of the day, we try to tell our clients and we try to educate folks to say, look, you're going to leave your business 100%. There's absolutely no doubt about that. The problem with the planning, there's a multitude of issues with planning for that. Most haven't planned for it, which I've already alluded to. And the other is there's really no dress rehearsal. We can't practice this. We're in the financial planning realm. We try to help folks model out this big financial decision that you're going to make one day as it pertains to getting out of your business. But we got to make sure we get it right. We can't fake sell our business and then say, oh man, we did this wrong, and then go back and undo it. There's no dress rehearsal for this monster decision. So it becomes a very difficult thing in our mind as a business owner and a dental practice owner to figure out, how do we contemplate this decision? And then how do we do the best thing for our practice, the best thing for us personally, for selfish reasons, and our family? There are a lot of folks in the financial planning realm that do really good work for business owners. But there are very few professionals in our industry, and I can say this because we've done the research. There are very few that focus on helping business owners understand what it looks like to properly plan for exit, to properly tee your business up in such a way that regardless of your path, you maximize the value of that business ownership. So there's very few resources out there. There are some accountants that do great work. There are some attorneys that do great work as far as exit, but there's no really body out there quarterbacking these efforts and quarterbacking these other relationships. It creates a situation where it's very stressful. Once again, we did not go to school on business ownership. We went to school to be really good at being a dentist. And the things that we've learned or acquired, the skill sets that we've acquired along the years, have been ancillary on our own time to figure out, how do we make this business thing work? So it creates this added level of stress. And Steve had alluded to this earlier. It's usually the biggest financial transaction of your life. Period. Without a shadow of a doubt, it's the biggest decision you're going to make on paper, and we got to get it right. We've got some practices where some family are involved, and that adds a totally different dynamic to things. And, how do we get it to my son if he's also, or she's also, well, he wouldn't be, but if they're also a dentist, that family dynamic can also play and add to the stress component. It's just a very difficult decision. We want to make sure that, I'm going to fast forward through a couple of these slides, but we just want to make sure that from the get-go, whether I'm talking to the 39-year-old that just bought a practice, or I'm talking to the 59-year-old that's thinking about things like retirement, there are one of three outcomes, period. One of three outcomes as it pertains to the ways that we can leave our business, and we call these doors. The first door is we can try to get our practice to an insider. We're thinking about an associate, a junior dentist that's in my practice. He or she has been with me for a little while. I'm very comfortable with the work they do. My patients know this person. They trust this person. The culture, hypothetically, theoretically, should stay the same throughout this process of transitioning it to this associate person. This is what we call an inside sale. And there's some pros and cons to that. I kind of mentioned or alluded to the pros of the possibility of culture continuing, people being comfortable. There are also some cons to it from a financial standpoint that we'll hit on and talk about. The second scenario is sell to an outsider. And in our world, from a dentist business owner planning perspective, we're thinking about the DSOs. That has picked up a lot. Corporations coming in, swooping up practices, grabbing that practice, grabbing that market share in that geographical area. I believe the last research we did, and Stephen, you could probably correct me if I'm wrong, but about 18 to 20% across the U.S. are corporately owned. The majority of what we still see are privately owned practices, especially in the state of South Carolina. But that DSO model is picking up pace. So a sell to an outsider is also a possibility. And then last but not least, we just keep the thing until we're no longer able to practice, whether it be due to health or, God forbid, I drink the poisonous Kool-Aid, I get hit by the bus and I'm out tomorrow. There's no right or wrong. There's no one size fits all, but we've got to start planning on what is my three doors. What are the three doors? And then what is the door that I prefer? And then what are the universal things that we can do along the course of this business ownership that will open up these doors in such a way that regardless of the outcome, we're still going to maximize the value of our business upon sale and the biggest check we can get. And once again, we want to make sure that we're picking the path that most suits us from a legacy standpoint. If I go through, I'm going to just hit on a couple of these slides here. So if we go through a business balance sheet, I'm going to share with you guys an actual business balance sheet and show you what we see most oftentimes. But we want to pay attention to 4 to 5 major areas of planning as it pertains to business ownership. Number one, we want to understand the value of our business. If it's our greatest asset, we've got to have a number on it. There are several reasons for that. If we're talking about things like retirement, that value is very important because one day when the sale of my practice generates a check and my paycheck stops as a result of being a dentist every day, that paycheck has to take over in the form of retirement income. So having a perfect marriage between that value or what it needs to be in the future and what that means to my personal balance sheet is very, very important. We've got to understand the value of our business. And it doesn't matter what type of business. Once again, that's very universal to business ownership. We want to grow our assets, grow our business. Our people are our assets, especially in a service-based industry that's so intimate like dentistry. You know, literally you're in people's mouths like you're working on their teeth. We've got to make sure that our people are good, they're well respected, and the clients and our patients actually want to come in and see our people. So we grow our business in the blue. We grow our people, our business through people, through things like retention of our best employees, attracting the right people to our organization based on the culture we're trying to create and the vision we've got. That blue is, in essence, the way that we grow this business value when we coincide that with being smart with our liabilities. Pretty simple math. Our assets minus our liabilities kind of give us our net worth, and the same is true for business ownership and corporations. They value businesses very similarly based on those two components in conjunction with cash flow. Cash flow is a big one. We do a lot of work in the cash flow domain, and we want to make sure that our business owners understand what's coming into our business from a gross revenue standpoint. How do we minimize expenses when it makes sense? How do we minimize our taxes within the scope of being lawful? And then at the end of the day, do we reinvest back into our business? Do we reinvest on our personal balance sheet? Last but not least, from a domain standpoint and from a planning standpoint, we've got to understand how to protect. If our business is our greatest asset, we've got to make sure that all the things that can go wrong, lawsuits, disabilities, it could be carpal tunnel that puts us out of work for a few months. We've got those boxes checked so that things keep hitting on all cylinders if that unforeseen, what we call black swan event happens. This is what the business balance sheet looks like. This is not proprietary to us. This is simple accounting. At the end of the day, we want to make sure that we understand these 3 possible scenarios. And I'm going to hit on 2 of the 3. I'm just going to assume for now that dying at the desk, so to speak, or having this thing until I just can no longer have it is really just kind of planning by default. Most people we sit with, that's not what they want their plans to be. But there are a few inherent challenges with whatever that path is. And I'm going to use a pretty straightforward scenario, which is selling to a third party. And once again, we'll keep using the DSO analogy because in the dental world, that resonates. But I'm using a hypothetical number of $1 million. And that's what our value is today. That's the practice value today. And we'll just throw a number, once again, arbitrary, and we'll say that this business owner is 50 years old and they tell us they want to be out in 10 years. And we can grow this business value. We're going to put a pretty aggressive growth rate of 10%. If that $1 million value were to grow at 10% for 10 years, that puts the value point at sale, meaning the actual value of the business on paper at 2.5, close to call it 2.6 million. From a planning perspective, you got to get with your people. If you've got people on your team that help you with making these huge financial decisions, you've got a retirement person, you've got an investment person. We have to understand what that value at point of sale should be, needs to be to generate the income that you want in retirement. We're not going to delve into that in great detail today. We could do that again on another webinar, and we can go through the math and all the hypotheticals. But we need to know what that value point at sale is. And there's some reverse engineering we can do to try to figure out how we get to that number What does the number need to be is the first and foremost. We've got to figure that out. If this business owner hypothetical owned 100% of the business, pretty straightforward and easy to understand, that $2.5 million, $2.6 million number hypothetically should all flow to this person when they get that check from that DSO. Part of the issue with the proceeds is it's not all yours. Accountants, and there's some really good ones out there, trust me, we lean on our accountants heavily, are really good for the most part of looking in the rearview mirror saying, all right, this is what you owed last year. Let's try to do a better job of minimizing your tax bill this year. In business ownership, what happens is these accountants are using your current year tax deductions, bring your tax bill down. You love them at the end of in April when you file that thing and it's way low number and you're like, man, I thought I owed more than that taxes. Well, they're taking these deductions as we go. We're depreciating equipment. We're doing all these things that aren't necessarily helping your net proceeds at exit. So the first eroding factor we have to think about from our third party sale is that check is really not the check you're going to get. You're not going to be able to spend that money. What does it look like? So there's the major form of taxification or taxes in the sale of a business come in the form of capital gains. If I own $1 million business, I put $500,000 of my own money into the business, I have a gain of the difference. However, if I've depreciated things, if I've deducted things along, that diminishes my cost basis. So a lot of these practices we're helping with that look at this third party sell option, the net proceeds just aren't what they need to be because taxes erode so much of that check upon exit. 15% right now, and it can be higher than that. Over the history of time, capital gains tax rates have been lower than the marginal tax rate on income, but that's always subject to change. The point here is a third-party sale can be a great way to get out. A lot of these practice owners, it could be dentists, it could be many medical professionals, they're hired back in to work for this corporation that buys them out in some form of consultancy role. It's to each his own or her own. We just need to know that at that third party sale, what does it look like and what do we need to be out in front of as far as things that may diminish that check. The alternative that we look at is some form of an inside sale. And I go back to that associate dentist. Her comes in and we're going to use some numbers here and says, look, I've been around here 5 years, Dr. Huskey. I want to buy you out. You're getting older. We can both acknowledge that. You got some gray hair now. You're not liking this as much. I can see it on your face when you get in here. You love your patients, but it's time to do something else. And Dr. Huskey says, yeah, I think it is. We've got to figure out a way for this associate person to buy Dr. Huskey out. Dr. Huskey loves me, but he's not going to just give me this practice ownership, this equity, this $300,000, $350,000, $400,000 a year income stream he was accustomed to is going to stop. He has to reap some sort of check, some sort of financial reward out of the sale of this practice. The problem with the inside sale methodology, and we see this all the time, is the inside person doesn't typically have the capacity to write a $3 or $4 or $5 million check. Whatever the value is of the business, they typically don't have that ability. In the medical professional realm, it's even harder because they can't go to the bank and get a loan for the full amount. The bank says, look, we love you, dentist, great, cash flow, great. It's hard to not make money if you do this properly, but we can't loan you $4 million, $2 million. You've already got all this student loan debt. You've got a mortgage. You've got all these things. So it creates this inherent issue where we have to figure out a way to get cash flow to the buyer, and the seller has to figure out a way to get cash flow to the buyer. And what happens by default, typically we see, is that business proceeds are used to generate that payment. This example uses some pretty big numbers. We're assuming a $6 million business value, which is a really nice dental practice. And we're assuming it over a 10-year period of time. And I'll go back through the numbers to help you understand what this means. But if we were to do a 10-year buyout, which is what we refer to as an installment sale, we're going to have this installment of 10 years. I'm going to get money as seller to buyer over 10 years. Buyer relinquishes ownership of the business in increments along over a 10-year period of time. Pretty easy math says we've got to get $600,000 to the seller to be able to get it back to the buyer. The problem with using the revenues from the practice, there are a number of different problems. The first problem is this seller is new to business ownership. They may have been around the practice.
The buyer is.
What's that?
The buyer's new.
I'm sorry. Yep, the buyer. My bad. Got it backwards. The buyer is now new to business ownership, and they may have been ingrained in the operations and everything, but now they're on paper, the owner of this practice, or at least part owner. They've got to generate this additional gross revenue to then turn around, pay tax on. That's the first level of taxation. This is tax number one. It could be as high as 40% on that $1. And we're assuming an S corporation here, which is a flow through. It just means it goes to the owner of the business, the taxes due. That buyer then turns around and gives this payment to the seller, who then also pays tax. The seller's paying tax on that capital gains tax rate. And with these installment sales, there's also some income tax paid because there has to be an interest rate fixed to these payments. The long of the short is it's a very inefficient way of doing things. Once again, to reiterate, this is using inside sale methodology and using the business solely to fund that buyout. Very inefficient way to do things from a tax perspective. However, the inside sale can be a really, really good avenue for certain folks, for certain practice owners to look at and to, go down that path of modeling out to make sure it does what you want it to do for your practice, for your family, legacy, all these things, fill in the blank. If we go back and we just go back to the previous slides, and then I'm going to be quiet because I think I'm coming up on 30 minutes, Steve-O. There's 100% certainty that you're going to do this. Like, this decision has to be made one day. There's a lot of planning that goes into this decision. And if we start out and we think about things with the end in mind, once again, you could be the 39-year-old in your first year. You could be the 59-year-old in your 20th year. We've got to figure out which one of those three doors are we going to try to exit, and reverse engineer plan, and using the help of our advisors around us. If you don't have a team of advisors, we're always open to a discussion. Absolutely no pressure there. But we want to make sure that these advisors that we're working with know what that door of exit is and understand why that's important to you. And then what does it need to be financially? What does that outcome need to be for you to be happy with the decision that you made? You work your tails off, blood, sweat, and tears to get through school. This is your baby. This is it. Let's get it right. And we've got to begin with the end in mind. Stephen, is there anything else you wanted me to go through? Is there anything else you wanted me to hit on?
No, I think you hit the highs, man. I think you kept it simple and educational. I appreciate that. And, for those folks who are going to be watching the replay, even the folks that are here today, please go to info@BlueWaterDentalAdvisors.com. Shoot us some questions. For those that have watched this, and we want to make sure that we are giving you the time that you deserve, especially for those that are interested in some form or fashion of some type of planning. You may already have some professionals in place, whether those are attorneys, CPAs, advisors, mortgage bankers, financiers, whoever you've got. Those folks should be speaking in tandem. They should all know your goals. They should all be providing advice that coincides with other pieces of advice that your other professionals are providing. All too often we get advice in a vacuum. And so it's really hard to decipher, to whom do I listen to and when, and how does it make sense to implement this advice? Having more of a macro advisor relationship with somebody who knows your goals and the culture of the practice and how to shift that to the new owner is an extremely important piece of the puzzle. Also, if you want to learn more about some of the exit strategies that we've kind of gone into today, go watch our CE content video. But that's all I've got. I think that, Brandon, you were eloquent around some of the processes that we talk about day in, day out with these folks. And great job on your first webinar. Couldn't even tell.
Thanks, man. Yeah, we'll do this again. And appreciate y'all for tuning in. lean on us if we can answer any questions, and we're always happy to be a voice of reason and try to give you some education and refer you if we can. So,
yep. So go to info@BlueWaterDentalAdvisors.com. Shoot us some questions if you're interested in understanding the true value of your practice as it stands today. We do provide an ability to provide an informal business valuation for folks who have an interest in that. So we're always happy to provide that just to start a conversation around what it looks like to get out of your practice. Even folks who are 34 years old, 39 years old, getting into a practice, it's important to follow the Stephen Covey model and understand that it's important to plan with the end in mind. So decisions you make today, like Brandon talked about, can have a positive or a negative ripple effect on how it impacts the eventual exit of your practice. So thank you for tuning in. We'll look forward to seeing you on other webinars we're going to provide over the next few months of this year, and we'll chat with you next time.